If you decide to move in between the year, you will benefit a lot tax wise versus moving in Jan or in December. Now, let's talk about TFSA and RESP. TFSA and RESP, the recommendation I got from KPMG was to dilute them and don't take them with you. Whatever stocks you have, you pay a departure tax on it. So I bought a stock for $10. The day I'm moving, it's $15, and now I'm moving to US. So the $5 that I've gained, I have to pay departure tax on it. So this is on rental income, and then whatever is the rental income I have to pay tax on it in US, which would be a differential tax. So if, let's say, I generated some income, I paid some tax already on it in Canada. Whatever is the differential tax, I pay it in US. So if the property appreciated by $500,000 for me and my wife owning the property, then I won't pay any tax. However, if 5 years are gone and then I sell the property, then I'll have to pay capital gain tax from the price I bought the property at. Then, even if you go back to your home country, even if you give away your green card, you are still considered tax liable in US for a certain period of time. I think it's 3 to 4 years. You'll continue to pay tax in US. Hello friends, my name is Bahroz. I'm a finance executive by profession, and welcome to my channel where I share with you how you can achieve personal finance and career success. Now, today's video is essentially a podcast that I had with my friend Yasin Nizami, who also has a YouTube channel where he shares knowledge around personal finance and Canadian economy or the North American economy. Now, in today's podcast, what I speak to Yasin about is with regards to the tax implications that I went through when I was moving from Canada to US. Previously, I did a podcast with Yasin where I talked about why I moved from Canada to US and what are the ways one can move from Canada to US. However, in this special podcast, we talk about what are the tax implications with regards to the assets that you are owning in Canada, your TFSA, RESP, RRSPs, property and all. Now note, I'm not a qualified tax advisor or a qualified accountant. I am just sharing with you the experience that I went through and the knowledge that I gathered when I was moving from Canada to US and all the information that was passed on to me. Now, the good thing was that when I was moving from Canada to US, my company, which I was working for, are the ones who transferred me, and hence they hired for me KPMG and PwC for exit tax briefing. So tax briefing with regards to exiting Canada and tax briefing with regards to going into or settling in US. So I have all the information that they shared with me, and I share all those information with you on this podcast as well. Again, this is not complete information and this is not full and final. The idea of this podcast is purely for you to have information and come up with smart questions that you can ask your CPA or your accountant if you are in a situation where you're moving from Canada to US. So this will essentially help you in terms of knowing what are the questions you need to ask. Because for instance, when I was going through that tax briefing, I frankly speaking didn't know what questions to ask. I was just listening what they were telling me. And later I realized there were a few things that I should have asked them or checked with them, which I didn't check. So all this podcast does is help you get aware with regards to what kind of questions you should be asking. Now, in case you find any value from this video, make sure you like and subscribe this video and to the channel so you get notified as soon as I put new content on this channel. Now, additionally, in case you are interested in getting qualified advice from a CPA, I will leave a link to a CPA that I've been using and have been very much satisfied with them. You can check it out, and I will leave their link in the description of this video. Now, let's get rolling into the podcast. It was a great podcast we had last time. I wasn't expecting such great feedback and questions on it, but it's always good to have those feedback and questions, and lovely to connect with you again on this. Let me just give some introduction here as well for people who haven't watched the previous one and they're watching this podcast for the first time. So my name is Bahroz. I'm originally from South Asia, Pakistan. I've lived in Middle East for around 7 years before moving to Canada. I lived in Canada for around 6 years, and now 2 years back I moved to US. I'm a Canadian national. I got my Canadian citizenship before moving to US, and then I moved with my same company to US. By the way, that's another question people usually ask as well. What are the options for people to move from Canada to US? Maybe a podcast for another time. I do have a couple of videos on that on my channel as well, but I think that could be a pertinent topic as well. If people are interested, make sure you drop down in the comments and let us know if that would be something of interest to you as well. I know, Yasin, you mentioned the caveat. I'm not a CPA, I'm not a tax accountant, not a tax lawyer. However, what I will be sharing with you here is pure knowledge that I have from the tax consultants and lawyers that I connected with when I was moving. So what happened was my company, I moved with my company. So they transferred me from Canada to US and they hired KPMG and PwC for me. PwC was in Canada, KPMG in US to do my tax briefing. So they explained to me what would be the tax implications for different things or different assets, different incomes that I expect to make. So all the knowledge that I will share is coming from them. It's not my personal knowledge. One. Second is the knowledge that I will share is pertinent to my situation or is relevant to my situation because I only ask them questions which were relevant for me. There could be many other questions that people may have. I never bothered to ask those questions because they were not relevant to me. And as we were just starting the podcast, one question is around pension planning because I consider myself maybe still young, and I thought pension planning would be something far away. That was not an immediate question that I had, and I asked them. However, I had questions around RRSP, RESP, TFSA, DCPP, property. By the way, I have two properties, one and both of them. One was my principal, non-principal, dividend. So these are the things I kind of asked them questions, and they explained me. And this is it's not an easy transition from tax point of view. And I think it's also very important that you do good planning before you engage into any transfer. So what I would say is the benefit of this video would be for you to have some idea before you hire a lawyer or before you hire a CPA and talk to them. So if you listen to this podcast, what it will do is it will help you list down those questions or those things that you want to inquire of them. So, for instance, when I was going into that briefing, I had no idea what to expect. I had no idea what to ask. Like, I didn't even think of asking them about TFSA until they told me the implications my TFSA would have if I don't solve or if I don't act the way the different options were. And I was like, I was expecting TFSA would be something pretty normal. So the benefit of this video is not for you to know I know everything about tax now and I will plan my tax. This video is not for tax planning. This video is for you to know or be more educated when you go and talk to your tax lawyer and know what kind of questions to ask them.
Yeah, no, this is good. I think this disclaimer is very important so that people, have the right expectation out of this content. So let's get started. Bahroz, thanks for the introduction. And I think the common question that we got in the comment section of this previous podcast was, okay, how do we know what are the tax implications that we're gonna have? Like if I'm a Canadian citizen, and I started to, I decided to move to US, for temporary job or maybe, I have a permanent plan to move there, and I have my TFSA account here. I'm also contributing into my RRSP. I may have RESP for my kids as well. Now that income is not going to generate any contribution in those accounts anymore because when I move to US, my income in Canada will stop. So what are the implications? What should I do if I leave those accounts as it is? Is it okay? If not, what are the implications, and how do I basically plan myself for any extra tax burden going forward?
Okay, so let's take a step back, Yasin, and let's first talk about tax liability in terms of your tax residency. So the tax residency is defined based on 180 days. Wherever you live in a particular year, more than 180 days, that's where your tax liability exists. Now, here I'll give a tip as well. I know I said this podcast is not about giving any tips and suggestions. Those tips should come from the lawyers, but this is a tip I would give just as a friendly tip, which is if you decide to move in between the year, you will benefit a lot tax wise versus moving in Jan or in December. Let me explain why. So my recommendation here is try to move in between the year versus earlier, that is maybe Jan or December. The benefit of moving in between the year is for me because I moved in June, I earned my income in Canada from Jan to June and I earned my income in US from June to December. Now the income that I earned from Jan to June was, let's say my income is $100,000, but I only earned $50,000 and suddenly my tax rate on that $50,000 is very low.
Mm.
And instead of paying, let's say, 40% on the $100,000, I'm paying 20% on the $50,000.
Right.
So I'm paying less tax rate.
Mm.
I was a tax resident of Canada for 180 days from Jan to June. So I only pay my taxes in Canada during that time because I'm a resident there.
Mm.
Now I change my residency to US. But again, I have half year of income. So I only pay tax instead of paying 30% tax, let's
Mm.
say on my 100,000 income of US, I only pay 15% tax.
Interesting.
So my average tax rate is 20 in Canada, 15 in US is let's say somewhere around 17 and a half.
Mm.
However, if I didn't do this, if I moved in Jan 1st, then the year before I paid 40% tax in Canada, and this year I would be paying 30% tax in US.
Yeah.
So I was able to manage, and this happened by fluke. By the way, I didn't plan it
Yeah.
this way.
Go
The
ahead.
company wanted to. It took some time for my visa to come, and it was only June, and kids were getting off from school, so I wanted to
Yeah.
start school as of July 1st. So I was like, let's just move in June. And only later I realized that I paid lower tax in Canada and I paid lower tax in US for that particular year. Now, of course, when the year follows, I'm back to paying normal taxes
Exactly. So basically, you pay less marginal tax in both countries,
in both countries for that year.
and I can tell you that people with with young kids with families, they prefer to move during the school holidays for a very obvious reason. So you will always find them moving, in June because the schools are getting off, and then so that when they start the new school, they should be settled in the new location. So this is pretty normal that families with young kids, they always try to move in that period between June and August. So that's a good point to consider. You can save some marginal tax in both countries if you plan that way. Okay, that's
Okay,
good.
so
So we understand now the tax implications in terms of how many days you resident in a country, right? 180 days
yeah.
is the minimum criteria. Okay.
Yeah. So for me, again, as I said, this podcast is all about me talking about my tax situation. This may apply to you, this may not apply to you. I can't help more than that. But for me, I was less than 180 days in Canada, and I was slightly more like I was 185 days in US, just because the way I moved in June, and I was like 178 days in Canada. So for that particular year, I was considered tax resident of US. However, any income that I generated in Canada was considered Canadian, was taxed on Canada. Any income that I generated then going forward in US was I was a tax resident of US. Now, you also have to let go of your ties with Canada, and there are two things you essentially are required to do. Not required to do, but it happens automatically. Is one is your health card. So you don't have to give health card to anyone back, but you stop getting the benefits of the health card altogether. So I won't be able to revise or renew my health card any further. And second is when I come here and I apply for driving license, they ask me for my Canadian driving license. I have to give them my Canadian driving license, and I got my Massachusetts driving license. So now when I travel back to Canada, I don't have my Canadian driving license anymore with me. Another question is, and again
Sorry,
now, yeah,
before we move on, so basically you surrender your driving license when you move to US, right? So you surrender your Canadian driving license in order to get the US driving license for that county,
exactly,
right?
exactly. That's
And
what
same
I
goes with, so for the OHIP, like if you are in Ontario, even you haven't informed the Service Canada, for example, or Service Ontario, and you became non-tax residents in Canada because of all those tax filings that you have been doing with KPMG and PAWC, it will automatically cancel your OHIP card. Is that correct?
so no, it's I had that question as well. I'm not supposed to use my OHIP card, but you can still use it. The issue is you won't be able to renew it. So, for instance, if you are in Canada, so I was in Canada once. I was traveling, and I had to get some medicine for my wife had to get some vaccination done, and she used her OHIP, and she got that vaccination discounted just because of OHIP. So she had to pay something, but part of it was discounted. But at least should not be using it. Or one, and second, I won't be able to renew it. So my OHIP, my kids' OHIP has already expired. My wife had some few days left, and we were able to get that vaccination. So essentially, you won't be able to use the health benefits, and you won't be having the driving license or that identity anymore with the in Canada.
So let's talk about the accounts that we have, the investment accounts, right? So we have RRSP for our contribution into the retirement. We have RESP for our kids' education, for example, and maybe TFSA for some stock portfolio that we are managing tax free. So, what happens to those accounts? Let's say if I move tomorrow and I don't make any changes into those accounts, but my, of course, Canadian income is not going to fund those accounts anymore. So, what's going to happen if I keep them as it is, or if, let's say, I take the money out and start investing into my savings accounts in the US?
Okay, so let's talk about DCPP. For DCPP, you can continue to make contributions if your employer allows such, and you can always like your if your employer has an agreement where they are putting 3% of your income from US income into the DCPP in Canada, and you're contributing on top, you can continue to contribute.
Oh, really?
That
So
is fine. There is
they
no
can allow
implication
you to
there.
contribute into Canada?
Yeah,
Okay.
it's not the case with me,
Hmm.
but when I was reading through the departure guide that KPMG shared with me, you're allowed you can continue contributing like that.
Yeah. So for the audience, I think BCPP is basically a employer funded retirement account. So you may have your employer also contributing into your retirement account to match your contribution, right? So that's called BCPP. Some also put their contribution to RSP, right? They can also match your contribution as well. So for my employer, they're matching my contribution into RSP. So some may have BCPP as well. So just to let people know.
Cool. And thank you, Yasin, for calling that out. I have made a video on my channel as well explaining DCPP, RRSP, RESP as well for Canadians. So if they're interested, they can check that out as well. But anyways, coming back to the point. So DCPP, you can continue to contribute if the company is doing it, but you would be hard pressed to find such an example where the company would be contributing to your DCPP in Canada because they have a 401k account here and they would like to open that. Like they won't be, unless you are really someone who's special for them and you want them to change their rules and their way of working for you. Otherwise, they have 401k accounts and they would want you to contribute there because that's how they treat every employee here. So this is one. Talking about RRSP, you can continue to contribute in RRSP as well, but now there is no Canadian income. So what happens is RRSP you contribute to save tax on that portion. So let's say if your tax rate is 20%, if I contribute $10,000 in RRSP, I get benefit of 20% on that $10,000. But if I don't have any income in Canada altogether, then there is no tax that I have in Canada. If there is no tax liability, I can contribute into that account, but I won't get any benefit. Unless you have some rental income, then you can do it. But rental incomes are not that huge unless you're a real estate giant. And if you are, then there is no point of you doing a job in Canada that in US. So, anyways, what I'm saying is that would be a useless contribution as well for you. Even if you can do it, it will be a useless contribution. The bigger question is, what if I take out that money? If you take out that money before moving into US, either it's DCPP or RRSP, you'll have to pay tax on it based on the tax rate for that particular year. By the way, that's another thing as well, which would be good to check with your tax lawyers, that how about if I take out that money the year when I'm moving out of Canada, because that year my tax rate would be lower. Assuming you're moving out in June, so instead of your tax rate being 40% that year, your tax rate ends up being 20%, and then you can take out all that money from RRSP that you've contributed at a lower tax rate. That was a thought that went into my mind as well. I was thinking, how about I take that money out? But then I was like, I'd rather keep it because I would also be earn. There is also benefit of compounding on that money, which is being compounded now. So if I take it out now, I'll lose 20%, which I could compound in future years. So I didn't bother taking it out, but that would be another good thing to check, which is if you've really structured your move in a way where you've lowered your tax rate for that year when you're exiting, how about you take all that money out at a lower rate?
And you never
So
know, right? You may have to come back at some point. So you don't
that's
want to
another
burn
piece
your
as well.
bridges completely. So you have to keep something behind so that when you come back at some point, you have something to hang on to it.
Exactly. Now, the good thing is in US, RRSP and DCPP are kind of treated the same way as they are treated in Canada, which is you're not contributing any further in it, but all the capital gain, all the compounding that is happening is not taxed till the time you take it out. So in US as well, I don't have to I have to report my account that I have an RSP account. This is the value in it, but I don't have to pay any tax on it. So for
Mm,
instance, if the value changes from being $10,000 to $20,000 just because the market went up,
mm.
I won't pay any capital gain tax on it, just like I would not pay any capital gain
TFSA,
tax on it in Canada.
yeah, just
In
like TFSA.
no, in RRSP and DCPP.
I think
I'll come
TFSA
to
is also the
TFSA.
same thing, right?
Yeah, no.
Yeah.
TFSA is very different. I'll come to TFSA. So
Okay.
RRSP, DCPP, any capital gains, you will not pay any tax in US till you've taken that money out.
Hmm.
Canada, just like as if you've taken it out in, if you take it out in Canada, you pay tax on it. Similarly, once you take it out, only then you pay tax. Okay, now let's say you are in US and you want to take your RSP out. What happens now? One is you have kind of two options. One is you pay 25% withholding tax in Canada on that amount that you've taken out, and that's your final liability. And then whatever is the capital gain that has happened on that amount, you have to pay a tax for that capital gain in US. And maybe there would be eventually a differential tax.
Hmm.
I think we should have talked about the differential tax as well. The good thing about Canada and US is they have a treaty, double taxation treaty, which is
Yeah.
you won't be taxed twice. You will be just taxed. You will be taxed twice in a way. Like if you pay tax in Canada, then you'll only pay differential tax in US. And if there is a tax liability in Canada for something that happens in US,
Hmm.
then you only pay differential tax in Canada. So it's not like I get taxed on something
Yeah.
20% in Canada and then I have to pay another 20% in US.
And And correct me if I'm wrong, I think the differential tax will be very minimal because generally the taxes are higher in Canada versus the US, right? So if you have already paid enough taxes in Canada, you may not be, taxed in the US. Um, Maybe a little bit of, the value, but it shouldn't be too much, right?
Exactly. It's not. It depends. So, for instance, my rental income. Again, what I do is on my rental income, the withholding tax is around the tax is it is around 25%. But my tax in US is 30% on my income. So I pay 5% more tax in US because it's just because I'm a non-resident rental income earner. I only pay 25% tax on that rental income. So for the most part, once you leave Canada, the income that you're earning there, the tax rate is lower. It's not the 40%, 45% marginal tax rate that we are paying. It's a lower rate. It's lower enough for you to have slightly differential tax payment in US. But it doesn't hurt me much because compared to when I was in Canada, what I am in US, my tax rates are low. Now let's talk about TFSA and RESP. TFSA and RESP, the recommendation I got from KPMG was to dilute them and don't take them with you because you can take them with you, but they are not treated the same way US would treat RRSP or DCPP in Canada. So RRSP and DCPP is kind of a replication here in US as well. TFSA is kind of, they call it, it's like considered a trust or something, and the taxations are very different. So any capital gain that happens on TFSA is taxed, unlike in US. So if my TFSA is $10,000 and it goes to $12,000, on that $2,000 I have to report it. I have to file a separate form and I have to pay tax on it. And filing that form would require you to hire a tax agent who you'll have to pay for. So for each form, you'll have to pay like $100, $200 in any case. So your tax bill, not just the tax liability, but filing the tax, hiring the tax lawyer and agent would be a pain in any case. I file my taxes myself in Canada. I understand a lot of taxation in US as well, but this is something I would not file myself. I made a mistake, by the way. I did dilute my TFSA. I didn't dilute my RESP, and that was a mistake I did. And in this year, I will dilute my RESP as well because I'm only getting support for filing my taxes from KPMG for 2 years. Next year, I'll have to file myself, and I don't want to be in a situation where I have to pay extra to the tax lawyers. Now, it is also beneficial to let go of your TFSA because you don't lose the TFSA room. So, for instance, if your TFSA you contributed $10,000, your TFSA went up to $20,000. Now you're exiting Canada. You can take $20,000 out. 5 years back, after 5 years, you come back to Canada. You can put those $20,000 back into TFSA, and then you can start your journey again on TFSA. But don't bring my recommendation again. It's not like legally it's allowed, but my recommendation is don't bring it in. And so much so, again, Yasin, take it with a pinch of salt because I don't have 100% complete knowledge on it. I remember there was in my briefing, I was also told, I could be slightly wrong on this, that the capital gain is not calculated from the time I exit Canada. the capital gain is calculated from the time I bought the share. So let's say bought the share at $10.
Wow.
The
So they
price
are
went to 15.
actually backtracking it and
Yeah, so I
okay.
lose. So this is what I remember, that I
Mm,
lose all the benefit, and I was so scared. I was like, I need to get rid of TFSA, and I don't lose any benefit. Rather, I get rid of TFSA. I move that money into 401k. I'm better off, and then 401k is also tax free. So it's like take
yeah.
$20,000 out. Let's say
Move
if
it across. Yeah.
I had Apple shares, take
Mm,
it out from Apple shares on the same day, buy Apple shares. So I lost nothing,
mm.
and now it's in
Maybe just a
401k, which is
transaction
also
fee
tax free.
and an
Exactly.
FX rate.
So
Yeah.
and then in future when I want to come back to Canada, I'll
Mm.
let go of my 401k and move the money into
Okay.
TFSA, or I just contribute something from my own pocket into TFSA.
That's a very important point. I don't think a lot of people know about this because we always assume TFSA is tax free, and
Yeah,
and even if you keep it here while you're moving out, you can still leveraging that tax free advantage. But in reality,
yeah,
it's
yeah,
not. Especially in the US, if you move across, then you have to file taxes there.
yeah.
Wow.
Now comes RESP.
Mm.
RESP, when you dilute as well, you'll have to give back the government the money that came to your account every year. So every year you get $500. If you contribute $2,500, you have to give that 500 back.
Mm.
Again, if you've decided to move to US and live there for long long term, then might as well get rid of TFSA and RESP both. You
So you
give
have to
that
you have to give back all the contribution that the government
yes,
has put in your
yes,
RESP account.
yes. Or if you can pass it to a relative, I think there is some science to it as well. But again, as I said, the objective of this podcast is for me to just give you areas you need to look into and ask questions. So when you talk to your consultant, a tax agent, ask them if there is a way for me to transfer my RESP account to a relative. I don't know if you can transfer to a brother, to a sister, to grandparents, if it's possible. That could be a way as well. So you can keep it with them, not keep it in your books. Or maybe your partner is not moving, something like that. But if it's not transferable, then I would recommend relinquishing it. Also, if you're not coming back to Canada eventually in next 2 to 3 years. So because if the idea was it's a 2 year assignment, I'll come back, then maybe you just bear the cost of reporting RESP, TFSA, and all, because you know you won't sell it. But I know if, for instance, if I have to be in US for long term and I have to, in some point in time, I have to sell my TFSA, I sell it earlier than paying taxation on it later. Also, on RESP, you'll also have to pay some penalty with regards to the capital gains that you've made in RESP in Canada, because you made capital gains not just on your money, you also made capital gains on the $500 that the government was giving you. Again, I don't have the exact number, but as I said, and maybe I'll have to repeat it a couple of times, is just I don't want to misguide anyone, that these are the questions ask your tax lawyer and tax agent. What happens to my RESP? Can I transfer it or can I not transfer it? If I dissolve it, what happens to the $500 contribution? It has to go back to the government. I know that. But what happens to the capital gains? How much is the penalty that I have to pay on the capital gains that I've earned on RESP? So understand all of that. So yeah,
And
this was
and
on the,
yeah, I just want to make a statement about the tax help. So if you need any help with regards to taxing in the US or in Canada, there will be a link in the description below where you can reach out to a certified accountant that can help you out.
cool. Now let's talk about stocks. Stocks which are not in TFSA, not in RRSP, RESP, unregistered account. Whatever stocks you have, you pay a departure tax on it. So I bought a stock for $10. The day I'm moving, it's $15, and now I'm moving to US. So the $5 that I've gained, I have to pay departure tax on it. So it is kind of a deemed disposition. So you have to assume as if you've sold that stock. And when you sold, but you haven't sold that stock, so you just tell the government of Canada, I bought the stock for 10. The day I'm leaving, the value is 15. It's $5 capital gain, deemed capital gain, and I will pay you departure tax on that gain. So that unrealized gain, you have to pay tax on the unrealized gain based on the date you leave, and that price becomes your cost basis for taxation in US, which is a good thing. So now for US, the cost of that stock is not $10 anymore. It's actually $15, because that is the time when you entered US, and the value of that stock was 15. But you pay on that, in all those capital gains, you pay tax in Canada the year you're leaving. And again, the idea is the year you leave. Uh, if you leave in the middle, your tax rate would be lower. So any dividends, anything that have also been generated, you kind of pay a lower tax on that. So there has to be a deemed disposition. You pay tax on it. For me, the good thing was, again, the day I was leaving, the market was at its lowest. So I didn't pay any tax in Canada on those stocks in because of the departure, or I paid minimal tax. Rather, I think I had slightly negative capital reported just because the market was went down majorly. Exactly. And then that became my cost basis in US, where the capital gain tax is slightly lower than Canada. So I kind of had slightly benefit that way as well. Similarly, let's talk about dividends. So any dividend that you earn on stocks which were US stocks owned in Canada, you have to report them in the US income. And any dividend, and you don't pay any withholding tax in Canada for them. So for instance, if I own a Apple stock, I don't pay any withholding tax for Apple stock owned by Questrade or Wealthsimple, the Canadian brokers in Canada, in the on that dividend. But if it was Bank of Montreal or some other local Canadian company, then I pay 25% withholding tax on that dividend income. And that is my full and final liability to Canada. So all dividend income that you would be earning on corporations, on stocks of corporations that you have for Canada, would be 25%, and that would be full and final liability that you have to pay, and that's it. So you don't have to file any tax return for any dividend income earned in Canada on Canadian corporations. And any dividend income earned on US corporations, you don't have to report that either as well, because for that income you'll in any case be paying in US taxation.
Okay, so just to rephrase, basically, so you have to pay only once 25% tax on the dividend income. Once you paid that, you keep those stocks in the Canadian accounts and keep generating dividend income, and then you don't have to pay tax anymore in the future.
No, I
Okay,
don't have to even file my tax for that.
okay,
That's 25% is full and final liability.
okay. That's good. That's good to know. I didn't know that. So okay, very interesting. So that takes us to the last point on my list, Barrows, real estate. So if you have your primary residence, or you had primary residence before you moved to US, now that became your rental property now, right? You may have another rental property as well. So the rental income that you're going to get, I assume that you have to file taxes in the US for that.
Yeah, so the rental income I earn in Canada, I have to file. So this is how it works. It's a bit complicated with the rental income. You have two options. One is called NR6, one is called NR4. NR6. So in one of them, you have to assign an agent in Canada, and probably I think it's NR6. You have to assign an agent. Let's say you're a real estate agent, right? So I assign you. What you have to do is you have to take the and NR means non-resident, so it's non-resident 6, non-resident 4. These are two options. You will collect rental from my tenant, and you will give that rental to me. So you have the responsibility of collecting the rental. And then when the year ends, you will give me an NR4 slip. Just like your employer gives you a T4 slip, you will give me an NR4 slip saying, Behroz, this is the amount of money that I took from your tenant and I transferred to you. So this is kind of your income that you've generated. And then I have to file tax on that income to say, okay, this was my income, these were the expenses, and my net tax is lower, and this is the amount of tax that I will pay.
And you pay taxes in the US, right? Not in Canada.
No, I'm talking about Canada first. So I have to pay taxes on my rental income in Canada. So this is Canada. Yeah. This is the only piece where I do have to file a tax in Canada. As I said, for dividends, I don't file tax anymore because 25% full and final liability, I don't file any documentation. For rental income, I do. I won't go into NR6 more because I didn't use that option. So maybe I'm not an expert there, but I'll tell you, not that I'm an expert on NR4, but NR4 is the option I took. On NR4, every month I have to remit to Government of Canada 25% of my gross rental income. So whatever is my rental income gross, 25% of that I will give to Canada CRA. This is withholding tax, 25%. Now at the end of the year, if I choose not to file, this is my full and final liability as well. If the year ends and I go like, I don't want to file any more taxes with file any return in Canada, like no documentation, nothing, that 25% is gone. because that is full and final liability that I have. But the issue is it is on gross rental income, and I have mortgage, I have other expenses. So my net is frankly speaking these days is negative because of the amount of mortgage rates are high and all. I don't want to pay 25% on gross. Then I have to file something which is called Section 216, and there is a form along with that where I tell them this is the money I remitted to you every month, which was on gross, and these are my gross and actual expenses, and this is my net income. And if my net income is negative, essentially, which is the case, I will be asking them for all the taxation that I've paid them because I don't owe them any tax. And if the net income is negative, it's like zero tax. If the net income is positive, then I pay some tax on it.
It is similar to like if you file the your rental income as part of your tax return in Canada, you also, you know, basically record all the expenses, the losses, like your mortgage interest, which is skyrocketed right now, your bills towards the property tax, management, maintenance, and all that stuff, and then whatever is left, then you pay tax on that piece.
Yeah,
So in your case, I think if the government is already taking 25% out of your gross rental income, then of course that amount is much higher than what you're supposed to pay at the end of the year, right?
exactly.
Yeah.
And it's essentially a cash hurt for me because I've paid them in advance the
Mm.
tax, which usually is not the case in rental income.
Yeah.
It's just like it's just like how you pay your tax in advance for your salary.
Yeah.
You pay them and then you get the money back. This is kind of what I'm doing here. But here the amount, the chunk is very big.
Yeah, and I think
Uh,
it is because you are not a tax resident in Canada, so the government will always take a withholding tax from you,
yeah,
right? Because they don't know whether you will be coming back or you will be fighting tax in the future, so they want to
true.
take their take first to make sure they have the money.
Exactly. And maybe that's why, and you said it right. And maybe now I'm thinking that's why they have the other option of assigning an agent. So either they have someone they can go to collect the tax, and if you're not any assigned any agent, then they want to make sure you pay in advance. So this is on rental income, and then whatever is the rental income I have to pay tax on it in US, which will be a differential tax. So if let's say I generated some income, I paid some tax already on it in Canada. Whatever is the differential tax, I pay it in US. Now, one quick and important break. In case you are interested in trading and investing using registered and unregistered account online, then I recommend this online broker for you, which I've been using since the time I came to Canada, and I have been very pleased with them. They have low cost fees and amazing service. The best part about them is whenever I needed help, their customer service is almost ready for them to reply me instantly. This online trader is Questrade. In case you're interested in opening an account with them, then I have a gift for you as well, which is a link that I will leave in the description of this video. In case you use that link, you will earn a $50 credit when you open your account with Questrade. So simply click on the link, open your account, and earn this free benefit. So this is for the rental income. Now let's talk about the property value. It's another monster in itself. If you have a house that was your principal residence, you were living in it, and now you're moving up to US, probably you'll put that house on rent. You don't want to sell it.
Mhm.
If you don't want to sell it, you have two options. One option is you have to tell, or you have to figure out what is the kind of the value of the house when you are exiting. When you're exiting Canada, what is the value of the house? Because that is the value of the house which will become the benchmark going forward for Canada for capital gains. Because if it's a principal property, you don't pay any capital gains on it. So
Right.
let's say you bought property for 500, the year or the day you're leaving, the property value is 800. So from 500 to 800, you don't pay any capital gains in Canada. So you tell the CRA that my property value is today $800,000. You move to US, you live in US for 5 6 years. Now you come back to Canada and the property value is 1 million. Since you already told Canadian authorities that the value of the property was 800, you only pay capital gain tax from 800 to a million when you
Delta.
come to Canada and you sell it.
Okay.
So essentially, that is the reason why you tell them my property value is 800.
I think it's the same principle applied while you are in Canada as well. So let's say if you own a property, you lived in the property for 5 years, and that property appreciated from $500,000 to let's say $800,000, and now you are buying another property and you are moving into that property as your next primary residence. So the property that you had before, which has been appreciated from $500,000 to $800,000, you don't have to pay capital gain tax on that. But In the future, if you sell that, your baseline will become $800,000. So let's say you sell it for $1 million in 2 years, then you only pay capital gain tax on that property for that delta only.
But what happened? So you put that property on rent,
Yes.
and then you move to a different property.
Yeah. Now that new property became your primary residence. The previous property will become your rental property, but you only pay the capital gains if you sell it in the future based upon the time. Yeah, then you actually change.
Okay.
You moved
Okay.
out, and the baseline that was basically considered the price of that time, for example.
Okay. Okay. Got it.
Yeah.
Okay. I didn't know that piece, but good. Good.
Yeah.
Makes sense. Yeah. So kind of similar mathematics here. Now, let's say you're in US and you decide to sell your property in Canada while being in US. So, and let's say the property value was 500. When you left Canada, it was 800, and you decide to sell it for, in next 3 years, the property doesn't appreciate,
Mm-hmm.
and you sell it for 800. Now, in Canada, you don't pay any tax because 500 to 800 is the capital gain. You already told them this is the capital
Yeah.
gain when I'm exiting. However, in US, you have to pay the tax. So, in US, when it comes to US, what the formula is that if you've lived in the property for 1 year in past 5 years when you're selling the property. So let's say I moved to US in 2000, and I in 2004 I decide to sell the property. So I've lived in that property 1 year in last 5 years, which was my principal residence. Then I will get a benefit of $250,000 per person. So if it's me and my wife co-owned, then we'll get a tax credit of $500,000. So if the property appreciated by $500,000 for me and my wife owning the property, then I won't pay any tax. However, if 5 years are gone and then I sell the property, then I'll have to pay capital gain tax from the price I bought the property at. So for me, the clock is ticking, which is I have a principal residence in Canada. If I sell it within the first 5 years, then I get the benefit of that $500,000 tax credit. If I don't sell it in the next 5 years, then I won't get any benefit. And all the benefit of capital gain, I'll have to pay in that I got in Canada, which I didn't have to pay tax in Canada, I'll have to pay tax in US. And the issue is, again, this is something that people need to check with their lawyers as well, which is what if you, and this is an important part, and maybe I want to say towards the end as well, once you have your green card and you've lived in US for around 7 to 8 years, then even if you go back to your home country, even if you give away your green card, you are still considered tax liable in US for a certain period of time. I think it's 3 to 4 years. You'll continue to pay tax in US. So for instance, if I decide not to sell the property, it's been 5 years, and I go like, shoot, now I have to pay tax on that property. What do I do? And I go like, okay, my time in US is done. It's been 8 years, 10 years, let's say. Let's move back to Canada. And once I go back to Canada, I'll sell the property in Canada. Once you go back to Canada, you sell the property in Canada, you'll have to pay that tax
Tax
in
in the US.
US.
Yeah.
And now that 500,000 benefit is gone as well.
Yeah.
So you really have to get rid of your green card, go back, serve the time. So those 3 4 years are gone, and only then able to sell the property. So
Right.
again, plan it now, which is if you want to sell the property, you have those 5 years to decide. If those 5 years are gone, then you are in a very different dynamic.
Wow. That is very complex.
It is.
and
It is.
and that makes me remind, I think, the quote from Robert Kiyosaki that I think part of the wealth management is understanding the tax rules. So if you know the tax system, then half of the problem is solved.
Yeah. There is another election as well, which I didn't opt for, but that is primarily if you are thinking that you'll come back to Canada very soon, you won't live there for long, or you expect that the value of the property will go down, then there is a way where you can use a formula to get some tax benefit. Again, if you've elected that, it's a complex formula, so that's again something that you can check with your tax agent, tax lawyer. But for me, the preferred option was to revalue the property for the date I'm leaving, so that all the capital gains that I've made, I don't get taxed on it in Canada. And now I have 5 years to decide whether I sell the property or not if I want to maintain those tax benefit.
Okay, interesting. Cool. I think this is a mouthful for sure, Barrows. A lot of information has been shared. And again, folks, we are not certified accountant. We are only sharing what we have learned so far on this journey with Barrows. So, always recommend to check with your lawyers and tax accountants so they can guide you better. And if you need any help, let us know. We can connect you to the accountants in the US and in Canada as well. So thanks, Bahroz. This is very helpful. And any last comment that you want to share before we wrap it up?
Thank you, Yasin. Thanks a lot. Great discussion. And as tax expert or CP expert once told me that you can save a lot of money, but all you need to do is you need to plan for taxation ahead. Most of us, what we do is once we are in that difficult situation, then we look for the CPA agent, and then we go like, okay, tell me how to get out of the situation.
Yeah,
And if you've done the wrong selections earlier, then you will struggle. So
yeah,
make sure you plan it ahead of time, as against saying, I will take the assignment and then I'll decide what happens to the tax. No, no,
yeah.
no. And
That's the
this was
wrong
the case with
approach.
me as well. When KPMG came to me, they said, don't sign the papers for the role yet. First understand the implications and then
Yeah,
sign. And
and
I
I can
was
tell
still,
you, pretty much everybody falls into this situation because we don't realize the tax implication until we get into the situation. A lot of people who are planning to move out of Canada, moving to US, they don't realize the future tax implications that they're gonna have with regards to whether these accounts, property, or anything that is related to that. So I think I can say pretty much everybody falls into it.
thank you, Yasin. So again, wonderful talking to you. And if people want to reach out, they can reach out to me on LinkedIn. I have two YouTube channels as well. One talks about Canadian life, Canadian immigration. It's in Urdu and Hindi, and the other one is in English, where I talk about career and financial success. Thank you, guys. Thank you for watching this podcast. Hopefully, this podcast was helpful for you to now have some idea with regards to how the taxations would work around, or what kind of tax implications you would get if you're moving from Canada to US. In case you found value in this video, I'm sure you'll find value in another video where I talk about how I left Middle East broke while I was able to become a millionaire in Canada. What are the tools and the process that I used? You can check it out here. Other than that, you can check out another video where I talk about how I go about making money through my passion. You can check it out here. Thank you.